Welcome to the latest installment of ABL Advisors video series featuring thought leaders from the commercial finance industry. I'm Mike Togley, the publisher of ABL Advisor, and today my guest is Mark Seigel, the founder and managing partner from Crown Partners. Thanks very much for being here today, Mark.
Thank you so much for having me, Michael. I've enjoyed your publication over the years and it's an honor to be here.
Thank you very much, Mark. I appreciate that. So today we're going to be talking about your view of the middle market lending environment from the perspective of a debt advisor. And I prepared a few questions for us today, so I'd like to jump right in if that works okay for you.
Shoot.
All right. So as a debt advisor, I'm curious how you would describe the middle market financing environment today. And is it the same, in your opinion, for bank and non-bank lenders today? What are your thoughts on that?
So first, overall, we're seeing extreme natural business demand. And I think that's a function of the robust general momentum in the economy. Of course, there's always segments that lag, some that were much more impacted by the pandemic than others. But as a generalization, strong economic activity. The major theme of the last 5 years has been the continued confluence of bank and non-bank lenders as yields merge. I don't have strong opinions between the two other than to say that both are extremely active and also competing both amongst themselves and with each other for middle market financings. And I don't see any specific demand drivers post-COVID other than what I described, which is the general robust economic activity. That's very different, by the way, than what I predicted in my interview with you in March when I launched Crown Partners with my partners. We believed that we were establishing ourselves in market to be ready for a period of lower demand among lenders and a disjointed supply-demand curve that has not developed at all.
So that's interesting you brought that up. So is that, again, a function of just, consumer enthusiasm, just an optimistic attitude towards what's happening in the economy today, or just a general, is there anything else you would attribute that to?
Well, of course, I always brag in these interviews that I'm aware I'm not an economist, and I don't try to be one. In terms of the actual data, so I don't feel that I have much to add with respect to attributing that to stimulus money versus animal spirits among entrepreneurs. What I can tell you is broad-based. The calls that we're having with middle market companies, by and large, is that they're doing well. Of course, there's current challenges, as there always are, whether you want to talk about supply chain challenges or work from home challenges. As a generalization, the types of financing that we're seeing are growth oriented, opportunistic, involving some aspect of engaging in economic activity, as opposed to a feeling of this has been a massive turnaround or restructuring period for us. That has not been the case over the last couple of months.
Okay, fair enough. And interesting how things have evolved since we did talk in March. So that sort of dovetails into my second question, but maybe it answers it already. And that was, during the pandemic and as it was going on, I think there was, as you had mentioned, there was a lot of expectation that there would be some more difficulties in the market. One of the things that kept coming up when I was talking to people was that they were expecting a significant amount of refinancing going on. Are you seeing a lot of the deal activity being mostly new activity or refinance activity, or a mix of the two more so these days?
That's an interesting question, Michael. I would say that the demand is refinancings, but different than I expected. So again, if I were to go back and reread my launch articles on Crown, my partners and I, who have extensive history in senior debt refinancings, were building a platform to serve the market and then be well positioned with momentum for what we predicted at the time would be a wave of turnaround activity. I didn't try to time it, but whether it was going to be now or in Q1 22, and to be ready, firmly planted in the market with talent and processes. What we have experienced through today is a significant wave of refinancing activity, but it is based on the driver of excess supply of capital and capital to be deployed that is increasing the pool of what is possible from a credit perspective. I believe that's a function of how well hard asset prices have maintained themselves during what appeared to be a 100-year flood from a potential credit perspective that never materialized on the by and large in our market, and then also a function of the relatively strong cash flows of the companies, generally speaking, in the industries that my area of commercial finance serves, which has been very strong. So we're seeing significant refinancing opportunities, which are improving the structure and pricing to borrowers.
That's really interesting because it's not the doom and gloom scenario where refinancings are being done because we have cash flow issues. It's an interesting development, isn't it?
Yeah, and I love to be a doom and gloomer. I love talking about concerns in the market. It's more, it generates more eyeballs and clicks and is more dramatic to speak about. The only basis for really talking about that as a whole generally is everyone's own psychology of this can't possibly continue, but that's not a real strategy or perspective. Inherently, every day that the economy improves and grows is one more day where it's more likely that a recession is upon us. All of the data points that we're seeing on the ground and in talking to prospects says that that trends are very strong currently.
It's very interesting insight. I appreciate that. So I'm going to move into another area now, if that's all right with you, and that is about the way deals are being structured today. And I mean that from a bundling perspective. It seems that there's more and more, and maybe you won't agree with me, but it seems that there's more and more activity where we're seeing asset-based loans being written at the same time as a commercial real estate component, including maybe even a CapEx line for equipment. It seems that seems to be going on more. Am I reading that correctly? Is that more prevalent today? And if it is, why is that, rather than going to separate lenders as many used to do?
Well, it's more prevalent today, but I have seen that trend for more than 5-7 years. I'll just back up for a second and describe a story. When I became president of a direct lending firm, I ran Veritas Financial Partners from 2006 through our exit in 2019. We had launched a term loan commercial real estate component paired with our core ABL business in around 2015, 2016. And at the time, we thought we were novel. And there was actually some differentiation from our direct competitors. That was a winner of a product. That opportunity closed linearly in the following 3 years as other new entrants moved into the market and replicated that. It wasn't a true strategic differentiator. It was a momentary tactical differentiator. The function, and that has only continued. The obvious reasons for that would be the general consolidation of specialty finance companies and the movement to bring them under one overall asset management umbrella. It's most of these products, whether it be an ABL product, a standalone term loan product, a purchase order component, those are by and large niche products. There are certainly in theory and definitely partially in practice some strategic benefits to having a multi-product platform that can leverage brand and business development, et cetera. And we've seen a few firms do a very good job of that. So there's also the funding component. Those products often are financed to the extent it's not being done within a bank and it's being done within a finance company, they have to themselves finance their lines of business. And often they are funded by different facilities. So it's just become more prevalent to bring that under one brand, which describes the desire to bundle. And of course, the goal of all companies is to cross-sell and serve their clients on a relationship basis as opposed to a transactional basis.
Yeah, it makes sense. And it seems, like you said, it's been going on for a while now, but what was unique at one point isn't anymore. I understand that. That's for sure.
I spent a lot of years describing something as unique that really wasn't, and became less unique year after year. And I lived that. And it's an example of always having to constantly adapt as a lender to find how the lender will serve the market differently than others, and try to compete not just on execution and quality, which we all try to do in this world, but actually have some true product lane. But that's gotten increasingly challenging to do.
An evolving market, that's for sure. Okay, great. Now, let's talk about the competition a little bit in the middle market. We all know that the competition is pretty fierce out there. It's between banks, non-banks, specialty lenders, whatever it might be. And of course, the bundling of the different facilities makes it even more competitive. But I'm just curious if you've seen any changes in the underwriting and due diligence standards that you're seeing on transactions from lenders. An example would be maybe loosening of field audit requirements, or maybe even a credit underwriting change. Are you seeing anything among the lenders that they're making changes to gain market share today?
I have not really seen that, Michael. It's something I have watched for, one as a student of the market and one who's curious about changing credit standards, but then also more transactionally, just so we're aware in market of where we can get the best execution for our clients. I have not seen any of the sort of excesses that can be associated with a credit bubble in terms of waiving field audits at closing, any real compression of timelines around closings. And I, in my travels when speaking to chief lending officers, chief credit officers, around the edges are firms trying to be to be borrower friendly where they can. Yes, but a lot of that means more cutting through red tape or bureaucracy, not actually waiving requirements. We recently closed what was a very clean, bankable ABL transaction with all of the strength one would look like in a transaction. And that bank, while they did a great job, was extremely belt and suspenders, and was not open really to cutting any of the corners that one might hope for a clean deal. Easy for me to say it was a clean deal. I wasn't the one taking the risk, but that's my live on the ground example.
Yeah, well, that speaks volumes, though, when you actually have an opportunity where you say, no, somebody's not cutting corners, they're actually going through all the process they've normally gone through. One of the questions I did want to ask you today was about the thing that's in the news everywhere, and that's supply chain. Okay, so supply chain, there's a lot of differing opinions on the impact the supply chain will have on the lending market, and whether or not that's going to cause some lenders to potentially exit some of the facilities that they're in with some of their borrowers, or perhaps take a look at rewriting those transactions. Now, some folks will say that supply chain is a temporary situation. Some will say it's a long-term one that we're going to be dealing with for a year and a half, 18 months, whatever it might be. What's your opinion on the impact supply chain will have, just from your perspective?
Yes, it's a topic du jour. My first answer is I tend to be of the camp of assuming things, large current events, err on the side of temporary as opposed to long-term. There have been some major global events I was very wrong about on that in the last couple of years. As for supply chain, when you speak to companies, every company is focused on addressing this topic. It is timely because it's jarring and affects us all personally. And we all see on the news these dramatic stories and how it may affect our lives temporarily. I tend to be of the camp that a year from now, we won't be talking about this issue, and that, of course, there will be some idiosyncratic opportunities over the coming months for middle market companies who are out of formula and where the supply chain challenges exacerbated an already existing problem. But I don't see this being a year from now one of the big storylines of the commercial finance market that that created a mass of opportunity.
Yes, tremendous insight, because I do hear different opinions, and that's why I want to ask yours from your perspective. So, with that, Mark, that sort of wraps up the questions I had for you. But before I go, I just wanted to give you an opportunity. Any parting thoughts? Anything else you want to share with our viewers today?
My parting thoughts are that over the last 2 weeks in commercial finance, there's been a return of live gatherings in mass. That has been a wonderful opportunity. My insights from those events are that the market is engaged, overworked, working on closings, and hungry to serve the market in whatever challenges arise. And I'm invigorated to be working with high quality folks that I like and respect very much. And I'm excited about the what seems to be the high energy in the market for activity, whichever way that represents itself.
That's great news, and it's good to be back, right? So it's only a positive.
Exactly.
All right, Mark, well, that wraps it up for me today. Again, I do appreciate your time very much, taking time to spend some time with us again. You've been a great partner for us here, and continue to cover what your views are of the marketplace. So thanks for being here again.
Thank you, Michael, for this and all you do for our industry.
You're welcome. Have a great day.